Good morning to Henry Jennings from Markets Today. This is our inaugural video broadcast of Dollars and Making Sense. This is going to be a multi-channel, multimedia universe extravaganza that we're going to be putting on as a weekly show. Joining me for the ride will be Henry Jennings, a stock analyst from Markets Today. So welcome, Henry.
Thanks, Ray. Good to be here.
And Henry and I actually go back quite a long ways. Our daughters actually went to school together, which is kind of ancient history these days, because when you've got daughters in their 20s, exactly. You try not to advertise that fact too much around the traps, but There you go. And I also welcome out of camera shot, our production assistant is Mitchell, my son, who is from Lazy Toast Productions, and he'll be doing our ongoing production during the course of the radio podcast and also the video as well. So you'll see that we'll be doing this as a regular thing. Part of what we're going to do is have Henry comment on stocks and the ASX, and then we'll go into general finance and investing. And as a licensed financial planner myself, I come across a whole range of different topics and articles that are always worthy of further discussion and investigation. So we'll be going through that. As part of the radio broadcast, I'll also be interviewing vendors, and I've already pre-canned many of these particular interviews from a national conference that both Henry and I attended earlier this year at the Gold Coast with the Australian Investors Association. So there's a wealth of really, really good content there that I think will be worthwhile for our listeners to catch a hold of. And the wonderful thing about modern tech is that you'll be able to get to those files at any time, 24/7. You'll be able to go to our website or to our Facebook page or to our Twitter feed and have a look for this content and pick and choose as you go. So first things first, Henry, as part of your weekly, part of your daily, in fact, rather than weekly, you write daily for Markets Today, don't you?
I do, yes, every day.
Okay, so can you tell me a little bit about that blog and how long it's been going?
Well, it's not really so much a blog. I mean, Markets Today is a financial newsletter. Mm-hmm. We have over 2,000 subscribers who pay a yearly subscription, and they get the benefit of our input from the Markets Today team, of which I am part of that. My specialist area, I guess, if you like to think of it as that, is small caps and medium cap stocks, looking for those kind of growth opportunities, both in tech, mining stocks, and anything else that kind of is interesting out there. Also write a lot of the macro strategy and comment on the economic environment and the ASX generally. I've spent a lifetime in stockbroking in various different roles, and I guess this is a culmination of that experience over the last too many years to mention.
Too many years, yes, that's right. Let's not go into that finer detail today.
Plus years, but certainly, I've been working with markets for about the last 4.5, 5 years.
Wonderful.
And been writing. I write a daily thing called Henry's Take, which is very much, as I say, focused on the small cap end of the market, and I run a small cap sort of model portfolio as well within that framework, and comment on anything and everything from US politics, Brexit, Italian politics, to ASX, to stocks, whatever.
So, for the benefit of the listeners and viewers, what does small cap and medium cap mean? Predominantly, let's say, in an Australian context, and how does that vary if you're talking the same terminology in, say, an American market?
Well, small cap is a different beast for different people. Some small cap managers won't look at anything below. Their idea of small cap is 5 billion, for instance.
So that's market capitalisation.
Market capitalisation. My kind of small cap universe is kind of capped at around 1.5 billion. Anything over that starts to become a larger cap. So I tend to look at stocks under 1.5 billion in market capitalisation, down to I guess you could call them nano caps in some respects, because they would be $10 million companies, $15 million companies.
Wow.
So companies are just starting out in their life, or maybe companies that are at an inflection point in their life because of a lot of mining companies. We've seen over the years how mining companies get backdoored with other companies coming into them, and they may have small capitalizations, but they may have some really good technology perhaps that is built in, that has got some growth potential. So anything, it's basically more a size thing from my perspective, because after a while it just gets too big. And what happens is that as they get bigger, research by the big houses then starts to come into these little stocks, and that once that happens, I kind of lose my edge to some extent because
that speciality that you have.
Yeah, well, I mean, my speciality is looking at these guys, but once they get too big, then the big houses will look at them. They'll be able to talk to management. They'll run the models. They'll have a lot more time and energy to expend on these, and a lot more money to throw at it. So they get better research, and as a result, they get better understood. So sometimes that initial opportunity has slipped by. So I tend to try and look at them as they're starting life. When no one else is looking at them, or at least no one in the sort of investment world is really looking at them or commenting on them, because they are just too small and they're just not worth the research house's time and effort, to be honest.
I know when I was trading years and years ago, I day traded for a little while, for about a year or so. Volume was a big thing that I was always looking for. Do you look for volume as well as a criteria?
Yeah, I mean, volume is volume and liquidity as well, because it's no use. Some of these small stocks, 85-90% of them sometimes is tied up in safe hands that are escrowed or not going to sell them.
Or say the directors of the company.
So the directors of the company, founders, or a private equity parent or whatever. So liquidity is certainly a big issue, because we've got all these subscribers who kind of follow what we do,
right?
And there's no use giving them stocks that are so volatile on the back of 10 shares or 20 shares. And there's a couple of ones out there. I think there's a stock called Audio Pixels, which is trying to develop a new kind of loudspeaker on a nano kind of level.
Wow.
Yeah, and they've been doing this for donkey's years, but it moves 5-10% on 20 shares. And it pops up in Iris, which is the sort of industry standard system, as a large cap. But in actual fact, the liquidity is ridiculous. So it's not just volume, it's about liquidity. It's about how much of the company free float is out there and how easy it is to trade, because there's no use recommending stocks that are impossible to buy and impossible to sell, because people just will get upset about that.
I think one of the things that I think you've highlighted there, Henry, is terminology that people, if you're in the industry and the trade, the terms like liquidity and volume and a second nature, and you understand that. But one of the things that I certainly want to open up to our viewers and listeners as we move forward over the weeks is that, if you're not sure about terminology, please send us a question, fire us an inquiry on our social links and ask. Because one of the things that I've always found is that, the industry that I'm invested in and my own fund as well is bonds.
Yep.
And the wonderful thing is around bonds, I find them quite simple. But again, a lot of people find them quite complex for no other reason that there's terminology in there that makes it quite confusing. But again, a quick 2 or 3 minute read and looking at definitions can demystify these investments quite quickly, and all of a sudden people go, "Oh, is that what it is?" Yep. And then all of a sudden becomes a lot easier.
Terminology, though, sometimes is used by the industry to keep people out rather than let people in, and it also is a good way to dress up something that is fundamentally simple in a more complicated language, and thus you can attach higher value to it. And if you can attach higher value to it, you can charge more,
of course. So. But again, I think one of the things, and again, one of the reasons why Henry and I have decided to do this particular podcast and YouTube channel is for education. I mean, obviously we are both business people. We have commercial interests in what we do, and we're not going to hide those. But the primary aspect of the reason why we're doing this YouTube channel and our podcast that's going to be on Radio Northern Beaches is all about education. So we find the better educated investors are, the better investors they become. And so, I've been volunteering now with the Australian Investors Association for 2.5, almost 3 years now. And the number of people that I know would absolutely benefit from being able to simply do a crash course in terminology sometimes would make them much, much better investors. And again, I come across a lot of SMSF trustees who I really am quite scared for them, because they're managing their entire portfolio and their retirement, and many of them don't know what they're doing. But anyway, we digress. We'll press on as the weeks go by. We certainly welcome ideas about how to educate and inform. I mean, I like to use the term investors informing and educating other investors, simply because it does. It helps people be better at obviously investing and protecting their capital and being better at what they do. So, Henry, looking at your latest insert on the web, this was from Friday's close.
Yeah.
Would you like to give us a bit of a wrap from Friday the 4th of October?
Yeah, I mean, we had an interesting week last week. There's a lot of things happening. October tends to be the bogey month. A lot of people believe...
It's historical though, isn't it?
It is rubbish, to be honest. It is absolute rubbish. The empirical evidence suggests that it's actually one of the better months of the year in terms of stock market performance. However, there are a number of events that have happened in October that have stuck in investors' minds, going back as far to 1929. Not that anyone listening to this will probably remember the stock market crash of Black Monday of October 29.
If you are out there, please let us know.
Yeah. But of course, then we had October 87, where there was another big crash. And we've had some mini crashes in the 90s, coupled around that October sort of cycle. And we've also had, of course, the GFC, which kicked off, well, certainly October was part of that happening. So it is a bogey month for the market. So what we have seen, though, historically, is quite a good month for performance-wise. But it does mean that there's a lot of volatility around. And we did see some of that volatility last week to the max. We saw the US have a couple of really nasty days. We had some interesting data coming through from the US in terms of their manufacturing sector and their service sector as well, on their PMIs. And these are kind of leading indicators of what's going on in the economy. And we've seen recently that the global growth has been slowing. This is very much a function of Trump's trade war with China. Remember, all the pundits called it a skirmish and it would never escalate. Well, you know what?
Here we are.
And next week, October the 15th, there's another $250 billion worth of goods about to be hit with a 30% tariff.
But let me just quickly pause for a moment. The PMI is something that wasn't subject. I mean, that's a quarterly report, isn't it? The PMI.
Yeah.
So we're talking about an indicator that has been in the making for 3 months.
Yeah.
So any talk about impeachment and the link of impeachment to this downgrade in the PMI really is fraught, isn't it?
Yeah, I mean, the whole impeachment thing is never going to happen. That's just an absolute furphy at the moment. It is a distraction for Trump. And at the moment, the markets have become very political in the last few years. And I think that's part of that is the big personalities, if you want to call it that are running big economies, whether it's President Xi, whether it's Trump, whether it's Boris Johnson. So I was going to put Scott Morrison in that, but obviously we're talking big personalities. So clearly not part of that discussion. But the impeachment thing, I think, is just a distraction for Trump. The big issue for the markets is this trade war that we have going and the implications that has for the Federal Reserve. There is an old stock market maxim that says, do not fight the Fed, and where the Fed goes, the market will follow. And at the moment, the Fed is being pushed, shoved, cajoled and bullied by President Trump, the bond market, investors, whoever, to cut rates. And that is the significant thing. The lower US rates go, in theory, the more people will have to invest in the stock market because there is no alternative. And we're seeing throughout the world this race to the bottom, if you like, in interest rates, whether it's in Australia, where we've now got ridiculously low interest rates, 0.75%. In some countries, they're negative. In Denmark, they pay you to borrow money for a mortgage. We've got to that silliness now. There's $17 trillion of bonds that yield negative interest rates.
And 10 of those are in Japan, aren't they?
10 of those are in Japan. So there's a lot of silliness going on at the moment. And we're seeing this volatility. And at the moment, we've got trade talks starting up this week between the US and China again. We've got Brexit looming on the horizon on Halloween. And we've got a Federal Reserve meeting on the 29th of October where we hope, and the market hopes, and that's the big hope for running into Christmas, is that they will cut rates again. And the US economy has been slowing. The German economy has been slowing. The European economy has been slowing. The French, the Spanish, the UK economy, all these economies have been slowing mainly as a result of this problem that we have over trade and the fact that we have this disruption to supply lines, supply chains, and tariffs hurting the US economy. Now, the big question for markets, having seen these PMIs, these purchasing manufacturers indices that are flashing somewhat red lights, is whether that has affected the consumer, because the American consumer is all powerful. They have 70% of GDP in the US revolves around consumerism. So they're all powerful, these American consumers. So the big question for markets is whether this deteriorating economy has had an effect on the consumer. And it was all leading into Friday night, where we saw the non-farm payrolls number, which is basically the US unemployment number, how many jobs being created, come in slightly disappointing at 130 odd thousand, but they did revise up some previous months, and the market is now going, well, okay, if that's disappointing, it means the Fed's going to cut rates. So the US market had a big rally on Friday. So we had 2 days last week where our market fell over 100 points. One day was 102 and the other day was 150. So there is this volatility now being baked into October because of the Fed, because of Brexit, because of all these things that are occurring. So it makes it an interesting month. It makes the market interesting, and that's good for people like myself who make a living out of writing and commenting and trying to find opportunities in the market, because to me, volatility means opportunities.
Yeah, well, volatility is good in that regard. If you are looking to make profits or call out requirements that give you an opportunity to profit, volatility is good. Thanks for watching Dollars and Making Sense. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances, and if in doubt, you should contact an authorised, licensed financial planner.
If the butterfly flaps its wings in Tokyo, then there's a problem in New York. We saw that in the GFC. The US subprime debt problem with housing and exploding, the automatic reset mortgages and exploding interest rates that they had, the ability to flip housing and all that sort of stuff that triggered the GFC, that washed around the world. And it's not without possibility that the UK leaving Europe on the 1st of November, in theory, unless Boris knocks it back and delays it, will have a significant impact to Europe. The UK is the second biggest funder of the European Union after Germany. When you lose your second biggest funding source, okay, that they're still going to have to pay the divorce settlement, but it has got the potential. And bear in mind as well that Mario Draghi, the Super Mario, whatever it takes man that saved the European project, the Euro, not that many years ago, he's retiring. He's got a new person coming in. Christine Lagarde, who was with the IMF, is coming in to take his place at the ECB, and we don't really know how she's going to handle the European economy. By all accounts, it's disintegrating as much as will require more quantitative easing and more bond purchases and more stimulus to get the economy. Here we are 11 years after the GFC, 12 years, and we've still got central banks having to cut rates, having to prop up our economy. That cannot last forever. We've just been kicking this can down the road with lower interest rates, with more stimulus, with more money printing, more debt.
But that's what we're in. That's what we're in for now.
That's where we are.
The reading that I do keeps on telling me that says we're in for at least another 25 basis points. QE is now on the agenda for Glenn Stevens at the RBA. So with regards to your discussions now around central banks, Henry, what control or what choices do you think the RBA has at this point in time?
Very little, to be quite honest. They talk about it as pushing on a piece of string. And we've seen that the tax cuts that the Morrison government brought in following the election and the recent rate cuts that the RBA has instigated haven't really had a lot of effect on consumer spending.
Most people have just banked it, haven't they?
Well, most people have banked it. Most people don't change what they pay in their mortgage. If the rate gets decreased, you just keep paying the same amount because that pays off your mortgage sooner. So it's kind of a way of enforced saving. The other problem that the RBA has, of course, is that the banks are independent. They're not, like they used to be, completely beholden to the RBA in terms of what the rate is. So they don't have to pass on the rate cut. And I think since 2011, the RBA has cut the rates by 4%, of which the banks have passed on just under 3% of those rate cuts.
I realise. And just so that people understand the difference, when the GFC hit and the Rudd government at that time came along, they actually stimulated the economy. They didn't give tax cuts. They actually wrote cheques, didn't they?
They did. And the difference is that writing the cheques is instantaneous.
So the sugar hit was immediate.
Chucking money at the wall was immediate. It provided stimulus. It provided confidence. It provided jobs.
The flat screen recovery.
The school hall recovery.
Yeah, absolutely. BER, I remember it well.
The pink bats, all those sorts of things were a big sugar hit. The problem with tax cuts is, one, they kind of get watered down over time, and it does depend on when you put in your tax return. And even when you put in your tax return, you may not get what they thought you would get back. So it's a bit more random. And then whether you go and buy a new whatever with that $900, $500 remains to be seen. And because it's staggered as well, depending on when you put in your tax return, you've got 25 million people all doing their tax at different times, then it doesn't have that same kind of impact that getting a check in the post, everyone getting a check at the same time for $1,000, go out and spend, guys.
It made a huge difference. And so I guess for a government that loves marketing slogans, your latest tax cut, where the bloody hell is it?
Yeah.
We haven't seen it.
Well, I have, but I spent it in Italy.
Oh, right. Well, good for you. But again, for those of us that have paid enough tax to get some benefit, and again, it's the which end of town ends up getting the stimulus and whether it has the kind of impact. And I have nothing against rich people. I want to be one day myself. But the impact of giving $1,000 to a millionaire is nowhere near as strong as giving it to somebody that's on 20 grand a year.
No, exactly. And that part of the problem that the RBA has is that no matter how much more they cut rates, will the banks pass on those rate cuts? Because at the end of the day, banking is a really simple game. They take deposits and they lend it to people, and they make a margin on it.
They buy and sell money.
And in the jargon of banking circles, that's called a net interest margin, or a NIM, and that's the important thing for banks. If they're giving depositors at 1% and they're lending it at 3%, they make 2% margin, and that pays for their costs, their bad debts, etc., etc., and that's their profit margin. Now the problem comes when you get interest rates so low as we have. The banks cut deposit rates to zero or close to it, they can't go negative. And if they're being pushed to reduce their mortgage rate, their net interest margin, the money they make on the money, gets smaller and smaller. And for an economy like Australia, and for any economy, you do need to have strong banks, because if you've got weak banks obsessed with regulation, compliance, remediation, royal commissions and these sorts of things, they stop lending. And lending is the grease that makes the wheels go round. This was the problem with the GFC. It wasn't that Lehman Brothers blew up. It was that no one wanted to lend to anybody else.
Yeah, the credit squeeze was on. And we're there again. I mean, I'm involved in bonds on a daily basis with my own investment fund. And again, we have calls on capital all the time. The demand for money right now to lend in a second and third tier environment is enormous, because the banks aren't lending anymore. I mean, if you've got a job, congratulations. But even if you've got a job, I can remember back in the good old days, it would take me 24, 48 hours to get a loan. It's taking 3 months now.
Yeah.
If you're lucky.
And you've got to jump through so many hoops. And it's all very well, we hear calls from Scott Morrison and Josh Frydenberg saying, these nasty banks, they're profiteering. You've got to use your feet and move.
Where?
The problem is, you go from Commonwealth to Westpac, the hoops you're going to have to jump through to get the same loan at a slightly different rate. Are you really going to be bothered?
Notwithstanding, I would highlight to everybody that's out there in listener and viewer land, is the switching costs. I mean, the last time I took out a loan, I got slugged 1% just for turning up, let alone the legals and everything else. So if you think about, you might save 0.5% going somewhere else, or a quarter, or whatever. You're still going to have to pay at least 1% plus stamp duty to simply do the swap.
Yep.
That's a lot of money.
It's a good ruse. I mean, at the end of the day, the banks they design their products to be sticky. They don't want you flipping around the whole time.
They are
Araldite. They are definitely super glued.
I mean, I'd love to swap from my guy at the moment, but I don't have a choice. ANZ, you got me. I'm stuck. You have my loyalty, whether I want to give it to you or not.
Well, that's exactly right. And what's even more frustrating as well is when you see, and we've seen this in the Fin Review today, is when loyal borrowers who have been with the bank and borrowing money for some time.
This gets my goat. Absolutely.
Are getting slugged with higher rates than new customers.
Yeah, that's what gets my goat.
It's really annoying, and this is not just confined to the banks. I had this conversation with Vodafone that were offering much better deals for new subscribers than some. I've been with Vodafone since 1995.
Wow,
which is a long time, because it was just part of when I worked for Macquarie Bank. We were with Vodafone. I've never changed it, but I was paying for less data, less everything, and I was paying more than a new subscriber when they came. And you talk to them and you say,
but again, my wife and I have this conversation constantly. You know, home contents insurance, car insurance,
insurance.
Everything. You know, if you don't shop, they just screw you. Yep. And I'm getting tired, because even now I will ring my insurer that I have this particular time around, and the first conversation I have with them is this the best rate that you can do for me? Yep. Because if they go, well, yes, I shop it. And so to all our listeners and viewers out there, I simply say to you, don't accept what's being fed to you, because loyalty doesn't pay. It just doesn't pay. And if you think it makes a difference, believe me, it does make a huge difference. When we're talking the difference in a home loan rate to what I'm paying, for example, compared to somebody as a newbie, we're talking 1.5 or even close to 2% differential. That's a lot of money when you're borrowing in excess of $1 million here in Sydney or Melbourne to buy a house.
It is.
That's not chicken poop. No. That's a lot of cash.
Yep.
Anyway, let's roll on. Henry, one of the things that I'd like to do on a weekly basis is to pick your brain on some of the gems, some of the trash that you're seeing out there, and maybe some hidden mysteries that you think we should be on the lookout, and maybe track those as we go week by week.
Yeah, hidden mysteries and tracking those. Last week was interesting, and there was one stock last week that caught my eye. It's a stock that I have followed for some time, and I've recommended it before and done very well out of it for clients. Is a stock called iSignThis, ASX code ISX. Now, iSignThis is basically a provider of know your identity,
KYC,
know your client software. And this is one of the big things with whether you're opening an account with any financial institution or doing any sort of new account transactions, is that you need to prove who you are, and they need to make sure that they are dealing with who they think they're dealing with. And it's all to do with the anti-money laundering.
Yeah, AML, yes.
This kind of thing. So it is up to the institution to know their client. And iSignThis has been very successful in providing software to companies, to CFD providers, to retail clients, to buy now, pay later clients. And we've all known that the
so this is the kind of thing that Afterpay
this is the kind of thing that Afterpay, well. ZipPay, all these buy now, pay later guys are doing. So they have to make sure that they're dealing with the person they think they're dealing with, as opposed to the Russian mafia that is trying to launder money.
No, they're usually at the NAB doing it on the terminals, the ATMs in Bondi, aren't they?
That is true.
50,000 transactions without a peep. Yeah. Sorry, did I digress then? My apologies. Sorry, we keep going. iSignThis.
So iSignThis has become quite a large company. I think it got to a market cap of around 1.7 billion.
Get out of here.
No, it's had a meteoric run up. And we, as I say, we recommended it to clients and got out, and they kept going a little bit further.
Where's it listed?
ASX.
ASX
listed company. Now, while I was away, there was some controversy came out because the management, as all good management does, managed to award themselves around $500 million worth of performance rights.
Kelsey, please.
Yes, there was a plot twist there.
They were doing so darn well.
Didn't see that one coming. And as a result, the stock price collapsed. It then won back some favours and tried to reassure the market. And it came out with some numbers, I think it was last Monday, which were taken by the market as very bullish. The stock rallied around 13%. On Tuesday, in a very strange move, and this doesn't happen very often, the ASX suspended the stock pending an inquiry from the ASX and ASIC about their activities. Now, it is kind of, it's usual, shall we say, for tech companies to dream up some sort of way of measuring them and how good they are in their growth, whether that in the old days in the internet.com boom of the early 2000s, it was how many eyeballs do you have?
Yeah.
How many clicks do you have? Now it's kind of changed a bit and morphed into other things. But these guys came out with this big number saying that they would basically involved in $1.7 billion worth of transactions, and they took a little clip of that as part of this Know Your Client procedure. I'm not sure whether the ASX and ASIC have taken exception to that, or there has been some other problems with anti-money laundering issues as well. But the stock has been suspended until further notice. That is quite a rare thing. Stocks go into trading halts. ASX stocks do have queries from the ASX on price moves, but it is pretty rare that ASIC and ASX say, guys, we have some serious issues.
But there was an IPO last year that got suspended as well. The lending guys, Prosper, they got canned 15 minutes before they actually listed. The ASX sent them a please explain.
And Latitude was pulled last year as well. So I mean, it's not unknown, but it is kind of rare for an ASX listed company. The last one that I can think of was Get Swift. GSW is the code, which is a last mile logistics software provider. It's a mouthful. But these guys, again, went on a meteoric rise in terms of share prices and put out a bunch of statements to the ASX, which frankly were complete tosh. And they talked about how they were going to become Amazon's logistics provider and doing the software for Amazon.
So the same people that wrote that PDS were the same ones that wrote the Dick Smith PDS, right?
Probably.
Fanciful writing.
Fanciful writing. And the
J.K. Rowling-esque.
Yes. and the ASX took huge exception to Get Swift.
As they damn well should.
Well, they did. It took them a while, though. It did take them a while. And it was another one, I've got to say, we spotted it. I spotted it quite early, the Get Swift thing. And I got out at $4.10 for clients. And they're currently about 60, and they went to about 15 cents. So,
wow.
so we did see the writing on the wall with that one. And there has been a kind of locally in our own Northern Beaches area. Of course, we had Big which was a software review company which reviewed restaurants and kebab shops and was massively valued at huge amounts of money until it was disclosed how they were making money, and it went bankrupt. Fly high, and then just dissolved into tears.
I mean, it reminds me of watching that company, that unicorn in America, WeWork, and when they first came out and started telling the world, look at this innovative way that we're doing things like Uber and other share companies. And I looked at it, and my wife looked and said, they're just a share office. And I went, yeah, just like Regus and like Servcorp. And I scratched my head because SoftBank then invested and valued the whole thing at $45 billion, and I'm just scratching my head.
I think the significant difference between WeWork and Servcorp is that WeWork give away free beer.
Alf Farage wouldn't do that in a month of Sundays, so I can tell you that.
That became cool and trendy to be part of WeWork as opposed to be part of Servcorp. So go free beer and you could probably wear a t-shirt.
Yeah, I was going to say, I having been part of Servcorp organisations as a renter, I could never imagine Alf Farage ever giving anything away. No. They charge by the load. That's why they're profitable, and good luck to them. You get what you pay for. But again, there's been big changes at WeWork now. The CEO's been ousted, and the market val last time I read was down from 45 down to about 4 or 5 now.
I think they were talking 8 when they pulled it.
There you go.
So it's probably now been renamed We Don't Work. So no, it was an interesting week last week from that perspective, and also we did see this increase in volatility, and we had a couple of nights in the US where things got pretty nasty. And our market dropped 250 points in 2 days. Remarkably, though, the small caps and the tech sector held up pretty well. I was quite surprised. Usually, one of the symptoms of this risk off, when people just retreat to the sidelines and go all defensive, we saw gold bounce quite a lot on the back of this big sell-off, is that the tech stocks, the high PE stocks, and for those of you listening who don't know what PE is, this is the price to earnings ratio. So this is how valuable the company is effectively compared to how much money it actually makes. And some of these tech stocks have got no earnings at all, so it's very hard to draw a valuation on a traditional PE basis. Some of them like WiseTech in excess of 100 times. But it's no
different to when the internet bubble was around 1999, 2000. they were talking about future earnings at that time. So look, we're just about out of time for today. For our inaugural broadcast, it's been a real pleasure to have you along, Henry, and I look forward to, week by week getting into some really interesting topics. As you can tell, listeners and viewers, there's literally thousands of things that we can be talking about. We're only just launching, so I'm going to be seeding this information through to my email database and hopefully getting some viewers and listeners coming in. Our radio broadcast starts next Tuesday at 8 a.m. at Radio Northern Beaches, and there'll be more details about that on our website shortly. But Henry, just to close out, do you have any particular stock that you think people should be looking at in the next week or so?
No. Is the answer. Not really. There was one stock.
Staying cash then, you reckon?
Well, we have been 100% cash in our real money portfolios for the last 6 weeks. It's been hard. It's not easy sometimes to be in cash and be watching from the sidelines. There are still significant risks out there. Some of those risks could be solved in the space of a tweet. If
Trump.
If President Trump said, "Hey, we've come to agreement with China," the US will be up 1,000 points.
And again, I guess listeners and viewers, there's a real salient lesson to learn. Sometimes the best thing to do is nothing. And I think sometimes even the best investors out there will sit on the sidelines and just say, you know what, this is too much for me at the moment. And sitting by and watching is not a bad way to go. So look, let's wrap up there for this week. Henry, thanks for your time.
Pleasure.
Listeners and viewers, thanks for listening in and watching. We look forward to your feedback and your questions via our social links. And until next time, this is Dollars and Making Sense signing off.